All right, guys, let's quickly take a look at the upcoming US CPI print. Now, something worth noting here is, I know every single CPI print, seems like the most important CPI print. But when it comes to this specific CPI, there is a lot riding on this particular event. It's not often that we get the CPI released on the exact same day as an FOMC meeting. Sometimes normally we get it, if they are close, the day before. So the fact that we're getting it the day of, it definitely increases, the potential volatility for a print like this. And there's also something worth noting, coming into this week, I was of the opinion that the Fed, the dot plots that we get, won't include today's CPI print, because normally they would have had their votes ahead of ahead of the release of a CPI like this, right? Normally they would have that vote either the prior night or the morning of, very early the morning of. However, there has been some conflicting reports coming out throughout the last two sessions. One of them from Nick Timmerose, who's considered, as you guys know, the Fed whisperer. He is a Fed insider. They have given him some insider information, not from a tradability point of view, but just information that they wanted him to convey to the markets previously. And he was out with a post yesterday that suggested that the Fed will actually wait for the data today that we get this morning, US morning time, and then potentially have the vote, right? So many of them will wait for the data before they put in their projections. However, there's also even other reports coming out saying that no, they actually already have the data. They would have gotten the data yesterday in order to be able to vote on the data today. So there's a lot of conflicting reports, purely based on the fact that we know Timmerose to be an insider, the fact that he has a lot at stake from a reputational point of view if he's wrong. I'm going to assume that they are either going to wait for the data and then vote, or that they would have had the data already yesterday and then voted on it. The bottom line is I'm going to assume that the Fed will know what this data is, whether they know it today or whether they knew it yesterday. Point being, I think this data will be included in the dot plot, even though that wasn't what I thought in Monday's session. So that's just worth, keeping in mind. Do I think that changes the way that I trade FOMC? Not really, but it obviously changes the way that the markets might react to CPI, and that makes a world of difference. Now, whether they have the information or not, it's not going to change the way that I trade this CPI event today. I'm only going to be interested to trade this if we get some seriously hot and sexy clear deviations to trade with. The reason for that is twofold. Firstly, because I'm unsure whether they will have the data or not. I'm going to assume that they do, but there is obviously the off chance that maybe they don't. And secondly, because this is pre-FOMC, there's always the risk that whatever we get today, the markets just discount it and wait for the FOMC anyway. I know this print is important, and I know the markets have been reacting to CPI, but for me to really want to trade this, I want to have that type of outcome where if I look at the data, I know it's going to be a good trade, right? Regardless of whether we have FOMC coming up or not. So for me, I'm going to be looking at those really clear, obvious deviations as a potential trigger to trade. If I don't get that, I'm happy to sit on my hands and just wait for the FOMC before potentially jumping into anything. So that's just worth noting from the start. Now, let's get into the nitty-gritty then, looking at the data. Markets are already expecting a slightly softer print today for the core year over year, expected that to drift down from 3.6 to 3.5. And they're expecting the headline month over month to come in lower from 0.3 to 0.1. The other two, headline year over year and core month over month, expected to remain flat. Now, when we are trading economic events like this, there's a lot we can do, and we'll look at a lot of this in under the hood. But generally speaking, what we want to see, whether we are looking for a dovish or a hawkish outcome, and by the way, I think both a dovish and a hawkish outcome, given the importance of a print like this, both can be very tradable today. We have seen obviously quite a lot of upside pre-positioning in the likes of the US dollar, which can change the reaction function for the markets a little bit. But because this is such a high profile print, if the deviation is big enough, I'll look to trade this as a dovish or a hawkish outcome regardless. So that's just worth noting as well. Now, when we trade these things, we are ideally we want to see the majority of these telling us the same thing. What we don't want to see is we don't want to see some of them coming in really hot and some of them coming in really cool. We want to see the same thing. We want to see the majority of them coming in with a big miss and majority of them coming in with a big beat. That normally gives us the best bang for our buck when we're trying to trade this. Now, what we normally look for in the case of a miss or a beat, let's say we're looking for a miss, we'll be looking for a move that comes in obviously below the market's consensus expectations, preferably something that could actually print below the prior and take out the minimum expectation. If it's a beat, ideally we want to see it beat the estimate, beat the prior, and potentially go above the maximum. Now, that is like your basic scenario to look at when you're trading economic data points, but we can actually do a lot more. We can go under the hood and go look at the forecast distribution, all of the analysts that was polled for these, and see whether there's any clear outliers and whether that gives us slightly different data points to look for. So let's quickly bring up the forecast distribution then for these, and let's take a look at whether we can find some numbers that make sense for us to trade. Now, in terms of, let's start with US CPI year over year, headline year over year. We know that market expectations for the year over year number is 3.4%, so markets expect this to remain unchanged. We know the minimum for that is 3.2%, and the maximum for that is 3.5%. Now, normally we would say, okay, above the maximum is tradable, below the minimum is tradable. But you don't have to be a rocket scientist here to see that, listen, that number at 3.2, that minimum, right? That minimum number is already a clear outlier in the distribution of the data. So we probably don't need to see a number below 3.2 to get a big reaction. If we get a number that is at 3.2, I think that should be good enough for a miss, because that is that's the clear low point here for the forecast distribution. Obviously below 3.2 will be even better, and that would be below the market's minimum expectation. But I don't think we need to print below the minimum. I think if we get 3.2 already or lower, that'll be a big surprise for a potential miss. So if we go back to our scenario planning, that'll be a print of 3.2 or lower, which is the outlier in the distribution. Now, let's quickly go back then. Let me just do this. And let's just get that data back. So let's look at the month-over-month number then. All right, so here we know that the forecast distribution is between 0.1 and 0.2, right? The minimum coming in at 0.1, the maximum coming in at 0.2. 0.1 is also the median or the consensus view. Now for this one, because we know the minimum is 0.1 and the maximum is 0.2, I'll very simply be looking for a number here below that minimum and above the maximum. We know the minimum for this is 0.1, the maximum is 0.2, so I'll be looking for a 0.0 or a 0% print, if you will, for a miss, and I'll be looking for a number like 0.3, which is basically in line with the prior for a potential beat. Very simple. Just the move outside the minimum or the maximum, I think, should do the trick for the month-over-month headline number. Now, in terms of core month, let's do core year over year first. In terms of core year over year, very simple here. We can see that the minimum expectation for that is 3.4, the maximum is 3.5, median is sitting at 3.5 as well. Now, again, you don't have to be a rocket scientist here. 3.4 is a clear outlier, right? Which means that we probably don't need to see a number below that. If we just print at 3.4 or lower, that'll be considered a massive surprise for the bulk of participants that was polled for this. So in terms of core year over year, either at or below 3.4 should do the trick. Not only will that be a clear outlier on the distribution, but if you take a look at the time series data, you'll see that anything below 3.6 is already going to be a new cycle low. So if we get 3.5 even, that's going to be a new cycle low. 3.4 will be a new cycle low. Anything below 3.6 will be that. But for me, I want a number this time round which is at that outlier on the distribution. That means 3.4 or lower gives me an outlier as well as a new cycle low for core year over year. So that'll be my threshold. Going back to scenario planning there, 3.4 or lower should be good for a dovish reaction. And then in terms of a hawkish reaction, 3.7 or above. Why do I say that? Well, if we take a look at the forecast distribution, we can see that the maximum is 3.6. So we can also see that that is basically a clear outlier already. So why not go for 3.6 or higher? Why go for 3.7 or higher? The only reason for that is if you take a look at the prior came in at 3.6 as well. For me to have real conviction, right? Real conviction that that the markets will be afraid of that print, I want to see inflation moving in the wrong direction. I don't want to see it staying flat at 3.6. I want to see it printing above 3.6, so 3.7 or higher. And that's also similar for the year-over-year headline. There, we don't just want to see it at, we know we want to see, let me just go back there. We know we want to see 3.5 or higher, but in terms of 3.5, even though that is just at the market's maximum, that gives us above the prior of 3.4, and it's the outlier on the distribution, right? So it gives us the max, let's say, shock factor for these two prints. If we can print not just necessarily above the maximum, but that also gives us a print above that prior reading of 3.6. So 3.7 or higher is what I would consider a big hawkish or ideal hawkish outcome. Now, in terms of the core year over year, let's quickly take a look at the forecast distribution once again. We know that the minimum there is 0.1 and the maximum is 0.3. Now, again, we can clearly see that 0.1 is a clear outlier. So if we look at the way that we looked at the others, I would consider 0.1 to be a good number. But even though 0.1 is clear outlier, 0.2 is an outlier year as well. So when it comes to the core measures, since that is the slightly more important one that the markets will be looking at, I think 0.2 or lower should do the trick because it is a clear outlier regardless of the 0.1s. There's only two of them. And in terms of a max number, anything above 0.3, right? So 0.4 or higher will already surprise everybody that was polled for this particular event. Now, if we just quickly look at that from a table point of view, for year over year, we're looking for 3.2 or lower, 3.5 or higher. For the year over year headline, we're looking for a 0 print or lower, 0.3 for a hawkish outcome. For a dovish on the core year over year, 3.4 or lower, 3.7 or higher. For a core month over month, we're looking at 0.2 or lower or 0.4 or higher. Now, again, in terms of expected reaction across the major asset classes, this doesn't mean this is how we want to trade it, but that is how we would expect markets to react on these types of outcomes. If it's a dovish outcome, we would expect dollar and yields to push lower, ES and gold to go up. For a hawkish outcome, we would expect the opposite, yields and dollar to go up, and ES and gold to see some pressure. Again, that doesn't mean that's the way we want to trade it. That's just the general outcome that we would expect from them. Now, in terms of possible scenarios, I'm going to keep this one really, really simple. If we get the ideal dovish scenario, I'm just going to be looking to short the dollar. If we get the ideal hawkish outcome, I'm going to be looking to long the dollar. Very simple. What currency pairs do I want to trade if we are seeing the ideal dovish scenario? I do like Kiwi dollar longs after the most recent hawkish shift from the RBNZ. Maybe Aussie dollar, because the Aussie dollar was the strongest currency at some stage today. It has given up some of those earlier gains, but it is still the strongest. So maybe Aussie dollar could be attractive as well. But as you guys know, I am still a little bit cautious on the Aussie dollar because I do think a lot of the recent good news is already reflected in the price. So I would probably opt for something like the Kiwi over the Aussie in today's session. And in terms of targets to aim for, we've got a couple of key highs to aim for here. I think that level between 61.70 and 61.80 is a good option because we've got the implied volatility high for the day. We also have this series, this short-term support and resistance structure in play, and obviously above that, a potential move back up towards 60, let's just call it 62 psychological. Those will be levels that I would be watching for the Kiwi. Now, in the event that we get a very hawkish outcome, again, I'll be looking for dollar longs as the easiest play. And after the weekend's political shenanigans in France, I think euro dollar shorts makes a lot of sense on the back of that. If you take a look at things like the BTB Bund spread, we have seen a bit of a move to the downside. On the back of that, that has given a little bit of a pullback in the euro dollar, but the pressure should remain, running into June 30th. So at these levels, I think euro dollar shorts makes a lot of sense. Counter rotation back down towards the lows from yesterday could be on the cards. That's 107.24-ish. Key level of support for the pair, by the way. And then below that, we've got that low going back to February, which also coincides nicely there with the 107 psychological as well as the implied volatility low. So two really clear levels that we can aim for to the downside if we get a hawkish outcome for the CPI. Now, the other options we can look at, again, my preference will be to stick to FX, but the other options we can consider on a dovish outcome is looking at T-bond longs, bond longs, Bonds have been supported since yesterday or since last night's really solid 10-year yield auction that we got. I mean, for those of you who haven't seen that data, really solid bid to cover, really solid demand coming out for that 10-year, which did ease some of those earlier concerns we have or had over the last 2 weeks about the 2-year, the 5-year, the 3-year, the 7-year auctions, which showed lack of demand. That wasn't the case last night. So bonds have been supported. We have seen yields pushing lower as a result of that anyway. So if we do get a really, really dovish print, then T-bond longs make some sense on that as well. And in terms of the other hawkish outcome we can look at is some potential gold downside, and that is purely going to be down to positioning. Why do we say that? If we quickly take a look at the positioning data, you guys would have seen this update already, but if I just quickly pop this on the screen, it's worth looking at this chart because it's just that it's a shocking one. Let's just quickly go to gold here. Take a look at that. I mean, you don't see that type of jump in positioning. You don't see that every day. That's massively stretched, in my opinion. And basically getting in at the worst possible time, given the news we had from China as well last week. So if we do get a massive hawkish outcome, apart from dollar longs, the other option that could be on the cards there is some potential gold shorts, where the first key level of support to aim for would be that 2,291, which is the recent support we looked at last week. Below that, though, we've got a lot of open room to run to the downside. I don't think targeting 2150, from CPI alone would probably be viable, because we do have FOMC coming up. But below that, I would stick to round numbers: 2260, 2240, 2220. All of them could be possible areas to consider for some profit taking if we do get that hawkish outcome. Now, what about an as expected inline print? If this wasn't a FOMC day, I would have probably wanted to get long risk with an inline print, because that shows inflation. Yes, it's not going down, but it's also not going up, which I think should be enough for risk sentiment to continue to stay positive, if that makes sense. But because this is FOMC day, I'm not going to do anything on an inline print. I just don't see a clear edge on this outcome. If we do get, an inline print, that probably increases the probability of a 2-cut dot for the FOMC, right? And that could be good news for risk, because that won't be a surprise. But again, I just don't see this providing anything to trade out of CPI. It arguably just makes our lives a little bit easier to trade the FOMC, because if we there get anything apart from a 2-cut dot plot, that could be very, very tradable if inflation just comes in as expected. So as expected or inline print, I'm going to do nothing. I'll be looking for that ideal situation on the dovish side, or ideal situation on the hawkish side for a print, or as an outcome to give me the base bang for my buck. Now, that doesn't mean I want to see each and every single of these measures printing like this or like this for a hawkish outcome. If 2 or more of them prints really bad and one of them is just flat, that might be good enough, right? Or if 2 of them comes in really, really hot and the others comes in flat, that might be good enough. So obviously use your own discretion when you trade this. It doesn't have to be these exact numbers for all of them. If it's bad enough, it could be tradable. If it's good enough, it could be tradable. But I will be playing it slightly more cautious than usual, given the uncertainty about whether the Fed will have this information going into the FOMC or not. Again, I'm going to assume that they have it, but it's just worth keeping that in the back of our minds when we approach the CPI.